Yes, it has been much more fun than the last 2 years prior. Innovation was punished as soon as, after COVID, people went back to work and supply chains, it was clear that this was really messed up and was going to be, and the debate around inflation and interest rates began. February of 21, we peaked. And we went straight down through December. And this year, I think partly because of ChatGPT, partly because more investors are beginning to tune into the disinflationary, if not deflationary, undercurrents at work in the market, and beginning to see, even if the Fed itself does not, beginning to see the other side of interest rates.
Cathie Wood, known for her innovation-based strategy at ARK Invest, faced significant challenges in the latter part of 2021 and 2022. The Federal Reserve and central banks implemented tighter monetary policies, resulting in her flagship fund experiencing an over 80% decline from its peak. However, the first half of 2023 has been more rewarding for innovation and risk assets as the market looks beyond interest rate hikes and embraces the fruits of exponential technologies like artificial intelligence, leading to higher valuations. In a recent interview, Cathie Wood shared her outlook for the second half of 2023, expressing her belief that it will be even better for innovation and risk assets such as artificial intelligence and cryptocurrency. She suggests that the combination of looser monetary policy and the inherent deflationary pressure of technology will fuel deflation, contrary to the prevailing expectation of high inflation. This viewpoint is supported by recent data trends, including commodity prices and the behavior of the Federal Reserve, which Cathie passionately dissects. According to Cathie, investors are overlooking an upcoming wave of deflation that will benefit innovation in technologies like crypto and AI. As deflation becomes evident, it will signal to central banks the need to quickly loosen monetary policy and lower interest rates to stimulate the economy. In such scenarios, assets positioned further along the risk curve tend to outperform. To delve deeper into Cathie's compelling argument, it is worth watching the complete video where she unravels the mystery of deflation and explains why this unexpected turn is bullish for innovation.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
I will say, as we look at the broad market, the narrowness, the breadth, it has dropped so significantly that many people are wondering about the true health of this market. Now, we think the resolution is going to be, and we're beginning to see it, as you say, in some of the less than mega cap tech stocks. We think the resolution is that the rest of the market will catch up if we're right on this notion that the big surprise, probably the biggest surprise out there for the second half of this year is deflation. I am shocked that, I think they have 200 PhDs, and I'm truly shocked that these PhDs are not holding up charts. If you look at the Bloomberg Commodity Price Index, it's down 29% year over year.
Oil stocks are the worst of the year this
year. Copper missed, the commodity with the PhD is breaking down. And so I think we're seeing a lot of deflation enter the pipeline, and that what the Fed is looking at, lagging indicators. I mean, horribly lagging indicators. M2 down 5% probably for May on a year-over-year basis.
Money supply.
Have not, yes,
which
money
never
supply.
Happens. China just
not
entered,
since the 1930s.
China just entered a bear market. And their economy is the slowest we've seen in our lifetimes,
the PMI came out today and was very disappointing. Right. Again, they exited zero COVID, and everyone expected them to create another commodity wave. That did not happen. I think the market is looking over the Fed, saying, wait a minute, there's so much evidence brewing here. Not only that there is deflation out there, but forgive me for using an identity in macroeconomics. It's very simple. It's an identity, and when people hear it, they say, "Oh yeah, that could be the risk here." So, what is that identity? MV equals PQ. PQ is nominal GDP, price times quantity, right? First quarter, nominal GDP was up 7%. Okay, so that's good. MV is money times velocity. The velocity of money is the rate at which money,
through the
rate
economy.
at which it turns over. We now, if you look at what happened in the first quarter, we know that M2 money was down 2% year over year. So what had to happen to get this 7% GDP? Velocity had to go up 9%, and it did. It's an identity. It had to. Okay. The problem now is we had a crisis, a regional bank crisis at the end of the first quarter. A crisis always, or during a crisis, people pull back saying, wait a minute, what's going on here? Especially when it involves the banking system.
Yes.
So,
a financial crisis, not a weather crisis.
Exactly. Right. So, second quarter, it looks like M2 will be down 5% year over year. And velocity, if we want to get the consensus nominal GDP numbers, 5 to 6%, velocity will have to be up 10 to 11%. It's not going to be. So I think that's why we're seeing some breaks here in pricing. I think that what is giving way is pricing, because the consumer has been saying, no mas, we're trading down, we are not. So I think that the margin pressure that we're going to see here is going to be serious. And an antidote to that is technology, AI, productivity gains. So I think innovation solves problems. I think that's another reason our stocks are doing well. Innovation is deflationary, right?
Once
and you
it
look
gets
at what
adopted,
Elon's doing. You look at what Elon's doing. Everybody thinks Elon is cutting prices because demand has fallen off, and it may very well. But he can afford to cut prices because his margins are so much higher than all of the other auto companies out there. And he has always said he would drive prices down in line with cost declines. Now, maybe a little bit more now because margins have come in. But this is the history of innovation. But we have so much innovation now taking place at the same time. I mean, I go through the 5 platforms, if I may, just quickly name them.
Please.
So multi-omic sequencing, that's going to, we used to call it DNA sequencing, but it's RNA, it's proteins, it's methylation, it's complicated. It's going to transform healthcare, highly deflationary. You've got robotics, same thing, industrial robotics, energy storage.
Can we back up? How is gene sequencing and the like, how is that deflationary? Because it seems to me that the better the medicines, the more expensive when they first come out.
So what I'll do is I'll lay out the 5 platforms along with the deflation that they're causing. And then, so.
Great.
Yeah. Let's take DNA sequencing. We've done the work on that. So we center our research on something called Wright's Law, which helps us understand how quickly costs associated with new technologies are going to decline. DNA sequencing, there are 2 flavors. One is
vanilla.
Long read sequencing, which is more accurate, more comprehensive, but more expensive.
Okay.
And then the other one is short read. If you know Illumina, you know short read sequencing. PacBio is long read sequencing. Long read sequencing, for every cumulative doubling in the number of whole human genome sequenced. So when we say cumulative doubling, it's 1 to 2, 2 to 4, 4 to 8. For every, and we're at a low base. For every cumulative doubling, costs associated with long read sequencing drop 28%. With short read sequencing, that number is 40%. If you look at industrial robots, that number is 50%. And that's at an extremely low base in the hundreds of thousands around the world.
This is robots to manufacture or to operate an Amazon warehouse?
Or to pick and place, yes,
yeah,
yes. Okay. That's right, in hundreds of thousands, so very low base compared to where we're going. If you look at energy storage and drivetrain technology, that is 28%. Batteries, sure. And drivetrains generally. Artificial intelligence is shocking us. So if we do Wright's Law, that number is 48% for every cumulative doubling of a metric of data that we use. Now, What's interesting about that is the cumulative doubling there is taking place in less than a year's time. So AI training costs are dropping 70% per year. Big Ideas 2023. So our chief futurist, Brett Winton, prepared a convergence section, the convergence between and among these technologies. And we have scored the impact of each of these technologies in catalyzing innovation generally. AI wins, hands down.
Okay.
So AI is the biggest catalyst and is involved in each one of these technologies. And we'll speed it along. So the way I like to characterize it so people really understand what's going on here is you have an S-curve, say, associated with electric vehicles. That's one S-curve.
Yeah.
You have another S-curve associated with artificial intelligence and autonomous mobility.
Right.
They're going to feed each other. The growth rates are going to be explosive.
Can you think of an example from the past where we've seen something like that? Would wireless and internet be?
Yes, and yeah,
so 20,
mobility.
25 years ago?
Yes,
Okay.
yes, and the iPhone capitalizing on. I mean, do you remember? Maybe you're too young, but I remember in 07 getting the iPhone and saying, "Wait a minute, I can get the
He's not that
internet."
Yeah, not that young.
I can get the
I know
internet.
I project youthful, but yes, I remember
youthful,
07.
Yeah, I can get the internet.
The iPhone.
There was so
Yeah.
much friction in getting information for investing before that. This was miraculous. That was, at that time, the epitome of convergence.
Here we have a fascinating dialogue featuring Cathie Wood, the founder and CEO of ARK Invest. Cathie not only challenges traditional economic analysis but also presents compelling arguments for why investors should be optimistic about the future of innovation, crypto, and AI in a potential deflationary environment towards the end of 2023. Her views diverge from the majority, shedding light on the potential power of deflation and its implications for the market. Cathie's insights remind us that it's not always about following the consensus, but rather the quality of the argument and the supporting data. She presents a convincing case that economists and analysts may have it all wrong. This serves as a wake-up call for all of us to stay informed, question our current assumptions, and remain receptive to different possibilities in the market. As we know, the financial landscape is constantly evolving and being reshaped by innovative disruptions. Cathie's thought-provoking perspective encourages us to challenge our perspectives and embrace the dynamic nature of the industry. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.